Well, as we expect the next couple of days to be volatile as the U.S. election is today and the outcome is unknown, our next guest believes there won't be an outcome that is strongly positive for the markets in the short term. Let's bring in Youngyu Mai's Chief Investment Officer at BMO Wealth Management. Youngyu, thanks as always for joining me. Lay out your base case here.
Yeah, thank you. It's great to be here. We do think that both candidates present a very different vision and policies, but when we look at the broad macro drivers, we think that's what's going to dominate over the medium term when we get into 2025 with lower interest rates, business spending still looking healthy. But we don't think that the markets are going to get excited about either of the outcomes of the election at the presidential level, or even how that pairs up with control of Congress. We think one outcome represents continuity, but a lot of regulation. Another outcome represents the potential for tax cuts, but also potential disruptions from tariffs. So we think it's a mixed bag either way, but when we look past this and look a few months out, we do think that the underlying economic drivers are quite strong still.
Well, let's talk about the short term just for a beat, because I think the view is, you know, the market can just continue. It'll digest whatever near-term volatility there is and just continue. My question is, do valuations make that difficult?
Well, valuations do present a headwind here. We do think that's true. Valuations are full. We don't think they're excessive. We think there's a lot that's priced in right now. On the positive side, we think that those high expectations can be met and will be met in 2025, but we don't see a lot of room for multiple expansion here. So a lot of the gains we think we'll see in 2025 are going to have to be on the back of earnings growth, which does look healthy, but we don't think we're going to get the sort of two-pronged strength of both earnings growth and multiple expansion, and the valuations are going to serve more as a lid on stock price gains rather than something that is a major impediment to the market.
So why are you constructive kind of after we get through this period?
Well, when we look at what's happening and where we've been in the U.S. economy, it's really weathered a lot of bumps and been able to overcome both inflation, higher interest rates. Consumer spending has stayed healthy. Business spending has stayed healthy as well. And we think that there's actually a lot of pent-up demand at lower interest rates. And with the Fed continuing to cut rates, we'll do so, we think, 2 more times this year, a few more times next year as well. We think that's a level at which some of that pent-up demand gets unleashed and there's more business spending. Along with the productivity gains that we saw this past year, we think those are set to continue. And overall, that mix allows for a nice lift to the economy and to profit growth.
Are you concerned that, tariffs really under either presidency could curb or affect, well, lots of areas of the market, but particularly tech, which is such an influential area of the market, as, rhetoric around China moves from rhetoric to even more tariffs and things like that?
Well, we do think that the two administrations do have very different visions and implementation of what a tariff policy would look like. Although both of them are relatively tough on China, we do think if there is another Trump administration that really ratchets up in terms of the risk relating to tariffs and trade disruptions. We do think that's a possibility, that presents a risk to us. More of a risk under a Trump administration. That could be a bumpy path going forward. We don't think it will be so much that it will derail the U.S. economy, derail corporate profit growth, but certainly there's headline risk. We saw that in 2018 when there was a tit-for-tat tariffs with China, and that could resume. But we do think even under a Trump administration that Trump would probably be out more to make deals, trying to bring manufacturing back to the U.S. rather than do things that are ultimately damaging for the economy. But it could be a bumpy ride to get to that point.
Well, and some of that would be inflationary. So, how would the Fed consider that? We've obviously got this Fed rate decision on Thursday. How are you factoring in Fed easing into your outlook?
Yeah, for the next 2 meetings until the end of the year, we think the Fed is mostly on autopilot. The big question mark comes in 2025, how strong wage growth looks like, the labor market overall, some of the inflation dynamics, and what the fiscal policy is, including tariffs, in terms of what comes out of the administration. It's also going to play into the Fed's consideration. We do think that if it's the case that some of the policies turn out, whether it's spending policy, tariff policy, turns out to create some inflationary pressures, that the Fed could surprise the market in terms of having fewer cuts next year than is being anticipated. We do think that's possible. We do think that probably come on the back of stronger growth, so that it's not something that means there's no latitude for the market to continue rallying. But we think the Fed is going to just take stock of what the market looks like and what the economy looks like, including fiscal policy as we get into 2025.
How's that going to show up in the bond market, which we've actually seen rates rise as the Fed has been cutting, particularly on the 10-year and the longer end. When do you start to worry about bond yields?
Yeah, that is a tricky one because we do think that a lot of factors are coming together that could present upside risk to longer-term bond yields. That includes stronger growth, which you expect to happen in 2025, but also includes things like greater fiscal spending, potential for tariffs. Where do we start to see have concern that the equity markets might reprice? We think that would be at levels well above 5% on the 10-year Treasury. We've been at 5% before. We've been able to digest that with some hiccups. We think the next level that the markets would really take pause and perhaps have a meaningful pullback would have to be more around 5.5% or above. So we think there's a lot of room between now and then, but it does represent a tail risk to the U.S. economy or to the U.S. market.